Hey everyone, and welcome to the Deep Dive. Today we're going to try to untangle something that might sound a little bit intimidating at first glance: capital structure. But stick with us because it's actually way more interesting than it sounds. We're basically going to be looking at how companies build their financial foundation. How do they get the money to run their business? How do they get the money to grow? Think of it like we're trying to decode the financial DNA of a company. And lucky for us, we've got some great sources lined up that break it all down. They give us the basics and even highlight some pretty interesting twists and turns along the way.
You know what I find really fascinating is that just like building anything, companies need the right materials. And in this case, the material is money. And there are a few ways they can go about getting it.
Okay, so let's start with the basics then. Let's imagine for a second that we're not talking about massive corporations.
Hmm.
Let's imagine we're just kids setting up a good old-fashioned lemonade stand. You need some cash to get started, right? So maybe you raid your piggy bank, or maybe you ask a friend for a loan. Companies kind of do the same thing, just on a much grander scale.
Exactly. Using your own savings, that would be like a company using equity, and then borrowing from a friend, that's like using debt. Those are the two core building blocks of a company's capital structure.
Debt and equity, those are the big players. Can you break down debt financing a little bit more for me? I have a feeling it's a little more complex than just hitting up a friend for a couple of bucks.
Oh, for sure. Let's say you're Netflix, and you need billions of dollars to produce the next big hit series. Debt financing would be like taking out a massive loan from a bank. You get the cash you need up front, but you're promising to pay it back over time with interest.
Okay, so it's like a mortgage, but for companies. So what are the advantages there, and what are some of the drawbacks?
Well, one advantage is that interest payments on debt are often tax deductible, which can save companies a lot of money. But the downside is that taking on a lot of debt can be risky. Like if Netflix's series flops and they don't bring in enough revenue, they could struggle to make those interest payments. And that could lead to some serious financial trouble.
That makes total sense. So debt can be a powerful tool, but it definitely comes with some risks attached. What about equity financing then? How does that work?
So with equity financing, instead of borrowing money, you're essentially selling pieces of ownership in your company to investors. Think of it like issuing stock. If you want to expand your lemonade stand into a full-blown juice bar, you might sell shares to your friends and family. They get a piece of the business in exchange for their investment.
Got it. So instead of taking on debt and having to pay it back, you're sharing the potential profits and risks with investors. So what are the good and the bad parts of going that route?
One of the biggest upsides is that you don't have to repay that money like you do with debt. But the trade-off is you're giving up a part of your company. Let's say your juice bar explodes in popularity and becomes the next big thing. Well, those early investors who bought shares, they're going to share in that success too, potentially earning a lot more than if they had just loaned you the money.
Okay, so it's a trade-off for sure. Get the capital you need without taking on debt, but you might be sharing a bigger piece of the pie later on. Sounds like choosing between debt and equity can be a pretty big decision for these companies.
Oh, absolutely. It's a real balancing act.
Yeah.
Companies need to weigh the costs and the benefits of each approach, and then ultimately decide what makes the most sense for their specific circumstances and goals. There's no magic formula here.
It feels like this could get even more complex than just debt and equity, though, right? Our sources mention a few other financial tools that companies can use. One that really caught my eye was this thing called preferred stock. Is this some sort of VIP stock option or...
You could say that. Preferred stock is kind of like a hybrid between debt and equity. Imagine you're investing in a company like Tesla. If you buy preferred stock, you're still an owner, but you get some special perks.
All right, I'm listening. What kind of perks are we talking about?
So preferred stockholders, they typically receive fixed dividends, and those get paid out before any dividends to common stockholders. It's like having a guaranteed slice of the pie, even if the company isn't doing incredibly well. Plus, if Tesla was to hit some hard times and face financial hardship, preferred stockholders get priority when it comes to recouping their investment. They're ahead of common stockholders in line.
So it sounds like preferred stock offers a bit more security than common stock, but what's the catch?
The trade-off is that preferred stockholders usually don't have voting rights like common stockholders do, so they have less say in how the company is run. So it really depends on your goals as an investor. Do you want that stability and predictable income? Or are you looking for greater returns and a voice in the company's decisions?
I see. So preferred stock adds a whole other layer to this capital structure puzzle. And it's not just about picking debt or equity, it's about considering all these different options and finding the right mix for the company.
Exactly. And believe it or not, there are even more pieces to this puzzle.
Oh, I bet. Our sources also mention something called retained earnings. I'm guessing that has something to do with profits.
You got it. Retained earnings are basically the portion of a company's profits that they decide to reinvest back into the business. Instead of distributing it as dividends to shareholders, let's go back to your juice bar for a second. Instead of pocketing all the profits, you decide to use some of that money to buy a new blender, or upgrade your furniture, or maybe even open a second location.
So it's like saving some of your lemonade money to make your lemonade stand even better.
Precisely. Retained earnings are a way for companies to fuel their growth and expansion without having to rely on outside financing.
Okay, so we've got debt, we've got equity, we've got preferred stock, and we've got retained earnings. But our sources also mention something called convertible securities and hybrid instruments. This is starting to sound like a gourmet chef's pantry of financial ingredients.
It is, and each ingredient has its own unique flavor and purpose. Convertible securities are like financial chameleons. They can actually change their form depending on certain conditions.
Okay, now I'm really curious. What do you mean by they change their form?
Okay, so imagine you have a bond that's convertible into stock. It starts out as debt. But if the company's stock price goes up significantly, you can convert that bond into shares of stock. It's like having a ticket that can be upgraded to first class if the flight is overbooked.
Wow, so you have the security of debt, but the potential upside of equity. That's pretty clever. Okay, so then what about these mysterious hybrid instruments?
Hybrid instruments are basically a blend of debt and equity features. One example is something called mezzanine financing, which is often used by companies that are in a high-growth phase but may not have enough assets to secure traditional bank loans.
Okay, so how would a company use mezzanine financing?
So let's say you're the founder of a promising tech startup that's developing a new app. You need capital to hire more engineers, and you need to ramp up your marketing. But you're not quite ready to go public and issue stock yet. Mezzanine financing could be a good option. You borrow money from a specialized lender, and that lender not only gives you the capital, but they also get an ownership stake in your company.
So it's like a loan, but with some equity participation. The lender's taking on more risk, but has the potential for a bigger reward if the company takes off. This is all starting to make sense, but man, it highlights how complex this whole capital structure thing can be.
You're telling me it's not just about picking one ingredient. It's about finding the right recipe that balances risk and reward based on the company's circumstances. It's a fascinating area of finance, and we're really just scratching the surface here.
I'm already seeing how understanding capital structure can give you some real insights into how businesses operate and how they make financial decisions. This is definitely a deep dive worth taking.
I agree. And in the next part, we'll explore some real-world examples of how companies have used different capital structure strategies to achieve their goals. So stay tuned.
Right, we're back. And so far, we've really dug into the building blocks of capital structure. We talked about debt, we talked about equity, and we even touched on some of the more exotic stuff like preferred stock and convertible securities. But as you said before, there's no one-size-fits-all approach when it comes to a company's financial structure. It seems like there are a lot of factors that influence a company's decision about how to raise money.
Oh, absolutely. It's definitely a dynamic process. Companies are always evaluating and adjusting their capital structure based on their specific needs, based on their goals, even based on things happening outside the company. It's like fine-tuning a recipe to get the perfect flavor, a little pinch of this, a dash of that to make it just right.
I like that analogy. So let's break down some of those factors then. One thing that really stood out in the sources was the importance of finding the right balance between debt and equity. What makes a company lean more towards one or the other?
Well, one of the biggest factors is the industry that the company operates in. Take utilities, for example. Companies like Duke Energy or Southern Company. They provide essential services like electricity and natural gas. Their revenue streams are usually very stable and predictable, which means they're a lot more comfortable taking on a higher proportion of debt.
Yeah, that makes sense. They're pretty confident they can make those regular interest payments without much risk of their revenue suddenly drying up. But what about companies and industries that are a little more, well, unpredictable?
That's a great point. Think about a tech company like Tesla. Their revenue is tied to innovation, consumer demand, competition. Their earnings can fluctuate a lot more, which makes having a lot of debt a lot riskier. If sales were to suddenly drop off, they might struggle to make those debt payments.
So a company like Tesla might lean more towards equity financing, even though it means giving up some ownership?
Exactly. Especially for those growth-oriented companies in fast-paced industries. Issuing stock allows them to raise a lot of money without that pressure of having to pay it back right away. It gives them more flexibility to invest heavily in research and development, or to expand into new markets, or even acquire other companies.
So it's like they're saying, we'll share the pie as long as we can make the pie bigger.
I like that. And sometimes giving up a slice of that ownership can be a really strategic move.
Yeah.
Think about the early investors in companies like Google or Amazon. They took a chance on what were relatively unknown startups back then. And boy, did that risk ever pay off for them.
Yeah, that's true. But our sources also pointed out that equity financing can actually be more expensive than debt in the long run. Didn't one of them compare it to giving away a winning lottery ticket?
Yeah, that's a good analogy. With debt, those interest payments are a fixed expense. But equity investors expect a return on their investment. They get a share of the company's future profits. So if the company turns out to be wildly successful, those early investors who bought in at a low price, they could end up making way more than the company would have paid in interest on a loan.
So it's a bit of a gamble. Companies have to weigh the cost of potentially giving away a chunk of future profits against the benefits of having that money now to fuel growth. Seems like there's a lot of strategy involved in figuring out how much ownership to give up.
You got it. It's a delicate balance. Sometimes giving up a bit of control can be the key to unlocking that exponential growth and innovation. Other times, a more conservative approach might be better.
It's interesting to think about how these decisions play out in the real world. So are there any other factors that influence a company's decision on how to raise capital?
Well, for sure. We've talked about the company's industry. We've talked about their growth plans. But even things like the overall economy can have a big impact. For example, interest rates can really sway a company's decision. When interest rates are low, borrowing money is cheaper. So debt financing starts to look more attractive.
Makes sense. But then when interest rates rise, debt gets more expensive and companies might turn to equity financing instead.
Precisely. It's a financial seesaw, constantly going up and down, depending on what's happening in the markets. And then you can't forget about taxes either. As we mentioned earlier, those interest payments on debt are often tax deductible. So that can make debt a more attractive option from a tax perspective. Companies need to consider all angles when making these decisions.
Wow, so there's a lot to consider. This whole capital structure thing, it's not just a static concept. It's a dynamic process that's constantly changing based on a whole bunch of internal and external factors.
You said it. It's like a strategic dance that companies do to reach their financial goals. Every step has to be carefully considered and choreographed.
It's fascinating to see how these decisions can really make or break a company. In the final part, I'm really excited to hear about those real-world examples you mentioned. Companies that have successfully managed this whole capital structure puzzle and done amazing things.
I think you'll find them really insightful. Stay tuned.
And we are back for the final part of our deep dive on capital structure. You know, as we've been looking at all the different ways companies can finance themselves, one thing that keeps coming up is this idea of ownership. Seems like a pretty big deal, especially for founders who, really poured their heart and soul into their businesses.
Yeah, it's a huge deal. And as we talked about equity financing, while it has its advantages, it does mean sharing ownership with investors. It's a trade-off that companies have to really think through.
You mentioned some examples of companies that have used equity financing really successfully, but one question that's been kind of bugging me is, when does giving up ownership actually make sense? I mean, our sources pointed out that equity financing can sometimes be more expensive than debt in the long run. So what would make it worth it for a company to give up a piece of the pie?
That's the million-dollar question, isn't it?
Yeah.
There are definitely situations where giving up some ownership through equity financing can actually be a really smart move for a company. Think about a company like Spotify back in the early days. They had this revolutionary idea for music streaming, but they needed tons of money to build their platform, to acquire licenses, to market their service worldwide. Traditional bank loans probably wouldn't have been enough.
So in Spotify's case, giving up some ownership through venture capital or angel investors, that was really the key to getting them off the ground?
Exactly. Those early investors, they didn't just put money to the table. They brought expertise. They had connections. They provided guidance that helped Spotify navigate that whole complex world of music licensing and technology. It was a partnership that really paid off big time for both Spotify and their investors.
Makes sense. So it sounds like equity financing can be especially valuable for startups with these really innovative ideas, but they maybe don't have access to traditional funding.
Absolutely. It's like planting a seed in fertile ground. It needs the right conditions and the right nutrients to grow into a strong, healthy tree. And for a lot of startups, equity financing is that essential nourishment. I mean, think about companies like Airbnb or Uber. They wouldn't be where they are today without those early investors who were willing to take a chance on their vision.
It's amazing to think about how those early decisions about capital structure really shaped the future of those companies. But equity financing isn't just for startups, is it?
Oh no, not at all. Think about a company like Starbucks. Let's say they want to expand rapidly into a new international market. They might decide to issue new shares of stock to raise a bunch of money really fast so they can build new stores, hire staff, and launch marketing campaigns, all at the same time.
So it's like adding fuel to the fire to accelerate their growth.
Exactly. And then there are also companies that might be facing some tough times financially. Like think about a company like Ford during the 2008 financial crisis. The auto industry was struggling, and Ford needed to raise money quickly. To strengthen its financial position and make it through that rough period, issuing new equity was one of the ways they did that.
Wow. So in that case, giving up some ownership was a way for them to survive a crisis
Yeah,
and come out even stronger on the other side.
exactly. The main point here is that equity financing, even though it means sharing ownership, it's a powerful tool that companies can use strategically to reach their goals. It's about finding the right balance between staying in control and opening those doors for growth, innovation, and resilience.
This whole deep dive has been eye-opening. We started with the basics of debt and equity. We explored the world of preferred stock convertible securities and even those hybrid instruments. We looked at the factors that companies consider when making decisions about their capital structure. And we even talked about the pros and cons of giving up ownership.
And I think we've shown that capital structure is not just some boring financial concept. It's a dynamic process. It's a strategic dance that companies do to fuel their growth, manage risk,
Yeah.
and create value for themselves and their investors.
It's been a wild ride. As we wrap up today, I'll leave you with one final thought to ponder. If a company's capital structure is like a recipe, what are the key ingredients that make a truly successful and sustainable financial model? What should companies prioritize when they're mixing and matching their debt and equity? Keep exploring, keep learning. And as always, happy diving.